we are coming into a market right now where I feel like we have so much uncertainty. There's the political risk, there's the political uncertainty, the inflation uncertainty, the economic environment uncertainty, the business environment uncertainty, all these different things that kind of are coming into play right now. And so I'm a big believer that we need to put as much money into guaranteed places as possible, that we have liquidity in them. So we have access to that money so we can take advantage of down markets. Hey, it's Chris with Life 180, and I have a question for you. Do you have an IUL policy that's maybe 8 to 10 years old or in that range? Are you uncertain about where the economy is going? Are you worried about the downside risk in the IUL? Because even though there's a 0% floor, you're still exposed to the cost of insurance and all the risks that come with that. Are you worried about future premiums and having to continue with that and the risk that you carry along with that for the rest of your life? Well, I was just made aware of a product and an opportunity that gives IUL people the chance to transition the cash value through the means of 1035 exchanging from an IUL chassis, and as long as it's not a MEC in the current IUL chassis, transition that money over into a single pay 1035 exchange whole life policy that will remain a non-MEC. And the beautiful part is you can use this for as a banking and savings alternative that gives you 4% guarantees, and it's a beautiful thing. Plus you never have to make another premium the rest of your life on this if you don't want. So what I want to do is I want to just take a couple minutes, if you haven't realized, that is an amazing potential opportunity. We are coming into a market right now where I feel like we have so much uncertainty. There's the political risk, there's the political uncertainty, the inflation uncertainty, the economic environment uncertainty, the business environment uncertainty, all these different things that kind of are coming into play right now. And so I'm a big believer that we need to put as much money into guaranteed places as possible, that we have liquidity in them. So we have access to that money so we can take advantage of down markets. So that's where I'm going with this. Now, everybody who is an IUL homer that's going to tell me, well, we could just borrow against the IUL policy. It's not that easy. I've done a lot of videos on indexing, indexed loans versus fixed loans, wash loans, if you will, with IUL policies, and it doesn't really work out the way that you're hoping it will. By transitioning over to a whole life policy, you have the ability to borrow against that money, leverage it for real estate, create cash flow, take advantage of down markets, learn how to thrive during those challenging economic environments. And to me, that's what it's all about. So I took a really simple example here and just tried to break it down and said, okay, let's say you were contributing money and now you have $100,000 liquid in a policy, in an IUL policy. And so this illustration, I should say, that I kind of ran with an example and just show you how powerful this is as a banking alternative. Now, mind you, we can do this. You could do this single payment premium with any money that you may have. It's just important to understand that if you do this with money sitting in a bank account, it's going to create what's called a modified endowment contract. And a modified endowment contract is going to not carry all the tax benefits that a whole life policy will carry with it. However, I will say this: if you had the choice to choose between having your money in a bank account, which, by the way, is going to earn you 1/10%, maybe 1% if you find a super high interest earning savings account at a maybe a certain type of bank, you can do that potentially. Good luck. Maybe a CD, if you're lucky, will get you 1.5% to 2%, and so plus those gains are going to be taxed, right? So the whole purpose of a MEC or avoiding a MEC is to get the tax benefits that go along with whole life. A lot of people like to kind of talk down about MECs, but at the end of the day, they're not all bad, right? Like when you compare them to other investments like a CD, or compare them to another savings alternative that have comparable guarantees like a savings account, they don't, the idea of a MEC isn't such a bad thing when you're comparing alternative to alternative, right? And so if you look at this, think about it. Think about the benefits that come along with this. You could do it. So the example I'm showing here is showing money that's 1035 exchanged from an IUL that is a non-MEC contract. Because that contract wasn't a MEC, you can 1035 it over into this, and you can take the $100,000, put it in there, literally month one, this is actually at the end of the first year because the dividend payments have been credited to this. So at the end of year one, you're gonna have $96,000. So you've lost a little liquidity of that $100,000 for the first year, but now you've put it into a guaranteed fund that you have liquidity, use, and control of that money. You pick up $423,000 of death benefit, and then it's gonna continue to grow from there. Now, you can see here, there's a 4% guarantee inside of this policy. It's going to continue to grow over here. Here's the current dividend scale on the right side. Here's the guaranteed dividend scale on the left side. Let's just go with the current side. I think the dividend scale right now is 5.25, so it's the guarantee of 4% plus a 1.25% dividend on top of that. And when you look at that, you can see at the end of the second year, you're breaking even. You're actually ahead of where you would be in a typical savings account, earning 0.1%, right? So this gives you the same liquidity that you're gonna have in your savings account because you can access that money anytime, but you're also picking up $423,000, $427,000, and as the policy grows, so there too does the cash value. It's pretty awesome stuff, right? So I think that's important to understand. Now, from a 1035 exchange from an IUL perspective, this is really powerful because it will give you certainty. A lot of times what happens, and I talk about this in a lot of videos, if you haven't already and you have an IUL or you're looking to educate yourself as an agent about IULs, click on the link above here and it'll link you right to the Indexed Universal Life training playlist that I have. It'll be extremely beneficial. I'm a big believer if you're selling these things or you're buying looking into buying an IUL, you need to understand all the nuances, all the caveats, all the moving parts, all the different ways and levers life insurance companies can manipulate these policies to actually increase the charges. One of the greatest ways is cap rates. I know a lot of people that have policies that are 10 years old. They bought these policies, they were sold these policies, IUL policies with 12.5 to 13% cap rates, and now those cap rates, because of those cap rates at the time, you were illustrated with 8% assumptions on an ongoing basis. But now the problem is those cap rates have dropped from 12 to 13% all the way down to 8 to 10%. And what happens because the cap rates dropped, the expectations in the policy has dropped, and so therefore the performance hasn't performed or won't continue to perform, I should say, the way that it illustrated. Now, it may not look so bad, but if you have an IUL that's 10 years old, that's 8 years old, maybe even 5 or more years old, what I would do is I would go to your annual policy statement and I would go on there and I would look at your current cap rate with your carrier. Because if you look at that current cap rate, what it's gonna do is it's gonna show you what you're earning, what you're able to on a maximum basis be credited based on the performance of the index you're participating in, right? Most people are not aware because the insurance company isn't gonna, highlight it or draw your attention to it because they don't even want you to know. But what happens is every insurance company will drop the cap rate, will drop the participation rate, will move a figure, because I know a lot of people that sell IULs will say, oh, mine doesn't have a cap rate, mine doesn't have participation rate, we have all these other moving parts. Well, guess what? The principle doesn't change. If the insurance company is earning 4.5% in their general fund, you can't separate the performance long-term. Maybe on a year-to-year basis, early in the policy you can, but think about it, early in the policy, you're during a surrender period, so it doesn't matter how much you're earning if you can't access it, right? Like that's the problem with it, and that's why they do it the way that they do it. Long-term, you're never gonna separate the performance of an IUL policy from the insurance company's general fund. And if these strategies were so good that the insurance company is selling you on, that your insurance agent is selling you on, that it can give you all this, let's say a 6.5% expectation long-term, why would the insurance company, who doesn't have to pay the insurance charges to use this financial strategy to get a return, why wouldn't the insurance company be using that strategy for themselves? All it takes is a little common sense to figure out that it doesn't work that way, right? Like insurance companies are masters of risk, they would be doing it that way. So if you've hit the point where you're through the surrender period enough and you look at your policy statement and you realize your cap rate has been reduced, or you're concerned about it because you absolutely should be, especially on policies 5 years or more old, And if you look at that and you're like, okay, I want to take what I have here, because remember, the last 11 years we've lived in a bull market. So even if your cap rate's gone down, there's a chance that it'll still be performing decently, right? Because as long as the year has performed higher than the expectation of, what the illustrated value on there, which let's say it's 7.5% or 8%, we've had most years have been above that over the last decade, right? So chances are your illustration did okay, even if cap rates dropped. But you need to understand what your cap rate is, because if you go back to that now and you look, and now we have a down year, 1 or 2 years in a row, which I'm a big believer is going to happen at this point in time. If we have that and your cap rate is reduced, now you're going to have a hard time catching up, because you're not going to have that 13% upside. You're only going to have an 8% upside. That's going to be the most you can earn from here forward. So you need to go look, you need to do an evaluation. And if you want to take, if you do look at that and you realize that, oh my gosh, like my cap rate has dropped, I've got this cash value here, I want to lock those gains in, take advantage of what I've done and the bull market that we've had, lock that in, keep liquidity, reduce the risk or eliminate the risk, and 1035 it into a place where I can still keep the tax benefits, keep the liquidity of the policy, lock in 4% guarantees, lock in liquidity use and control that money, and be able to take advantage of down markets. This is the strategy for you. So if you have any questions about this, you can go see here, like look at this policy, right? Like you got $100,000 going in, you got $96,000 year one, so you're really only losing just under 4% of liquidity. 3.6% of liquidity is all you're losing in here. So it's not, you're picking up the death benefit there, which is phenomenal. And remember, if this were a bank account that you were keeping your money in, I love the tax benefits of whole life. But if you were transitioning from a banking alternative in this policy and you wanted to create a MEC, you still get all these benefits. It's still super leverage. Now, you're not going to have the tax benefits of tax-free growth. So this growth is going to be taxed, but the death benefit from an estate preservation perspective or an estate enhancement perspective, the death benefit is still going to be tax-free, right? And so even though the growth is going to be taxed, and I can't illustrate that here, so you just have to look at that and understand it, even though that growth will be taxed, it's still going to outperform your bank account, and you pick up all this ancillary death benefit, right, on the side, at ultimately no cost, is really, if you compare the two apples to apples. And this is going to have, in my argument, is going to have better guarantees in your bank account, because banks during the last financial crisis, a lot of banks failed. They went out of business. And yes, the FDIC is there to protect you, but no major mutual life insurance company has failed during a financial recession over the last 100 years. Not a major mutually held life insurance company has failed. And so that's important to understand, because they don't use fractional reserve banking. They don't leverage in the same way that banks do. What's your money is in there, it's earmarked for your use, and life insurance companies are masters at managing risk, and that's why they do what they do. And so, I guess this is an amazing solution. I was blown away when I saw it. It's very simple, it's very conservative, but I'm a big believer you shouldn't use your life insurance policy as an investment. You should use it as a storage vehicle, like a bank account on steroids for your money, storage vehicle that gives you safe, guaranteed returns that you don't lose liquidity in, right? Because if you don't lose liquidity now during hard times, during economic corrections, when real estate prices go down, when crypto prices come down, when stock prices come down, you have liquidity to buy at the right time. Warren Buffett always says you make money when there's blood in the streets. So when everybody else who hasn't structured their life to make good financial decisions is struggling, you're able to come in and get wholesale prices, fire sale prices on assets that have overcorrected and have devalued more than they should have, and you get to maximize your returns in the process. And so anyway, I hope that makes sense. If you have any questions at all, you can go down below, click on the link, set up a time to talk to the Life 180 consultants, and have a conversation to see if you want a policy review, if you want us to look over anything. Go down there, check that out, set up a time to talk. We're happy to help in any way possible. But anyway, I hope you found value in this video. If you did, please hit that like button. If you haven't already, make sure you hit that subscribe button, hit the bell. That way you get notified every single time I launch a new video. And that's it. Hope you have a blessed, inspirational day. We'll talk to you soon. Take care.